This is an overview of Chapter 7, Internal Controls and Cash. We're going to talk about Sarbanes-Oxley and its impact on internal controls and financial reporting, describe and illustrate the elements of an internal control, illustrate the application of internal controls as related to cash, describe the nature of a bank account and its use in controlling cash, the use of bank reconciliation, special purpose cash funds, reporting of cash and cash equivalents on financial statements, and the use of days cash on hand. Sarbanes-Oxley, as we talked about in previous chapter, is referred to as Sarbanes-Oxley Act is referred to as Sarbanes-Oxley and applies only to companies whose stock is traded on a public exchange referred to as publicly held companies. Its purpose is to maintain public confidence and trust in financial reporting of companies. Sarbanes-Oxley highlighted the importance of assessing the financial controls and reporting of all companies. As a result, companies of all sizes have been influenced by Sarbanes-Oxley. It emphasizes the importance of effective internal controls. An internal control is defined as a procedure or process used by a company to safeguard assets, process information accurately, and ensure compliance with laws and regulations. Sarbanes-Oxley requires companies to maintain effective internal controls over the recording of transactions and preparing of financial statements. So these are lame pictures, but before Sarbanes-Oxley, there was no real requirement to have internal controls. And their fear was, or there was actually, related to Enron and several other companies, fraud and theft. And then they enacted Sarbanes-Oxley, and they think that from effective internal controls, they will eliminate fraud and theft. I don't think it'll eliminate fraud and theft, but it reduces it, especially because usually this happens with the knowledge of the CFO and the CEO. It's hard to get that kind of fraud in a publicly traded company without their knowledge. So now they can be held personally liable. They could have jail time, and they sign the financial statements. So the companies must use an independent counter to report on the effectiveness, and the reports are required to be filed with their 10K annual report with the SEC. This is an example of a management report. Our management is responsible for establishing and maintaining adequate internal controls over financial reporting. Our management, including our principal executive officer and principal financial officer, conducted an evaluation of effective internal controls over reporting on the framework in Internal Control Integrated Framework issued by the committee sponsoring organizations of the Treadway Commission. So they go on and they talk about eBay's internal controls. The objective of the internal control is to provide reasonable assurance that assets are safeguarded and used for business purposes, that the business information is accurate, and that employees and managers comply with laws and regulations. So, like we said, compliance, accuracy, and safeguarding assets. A serious concern of internal control is preventing employee fraud. Employee fraud is the intentional act of deceiving an employer for the personal gain. This happens, it happened in large scale companies, but it also happens in smaller companies. For example, the bookkeeper or the accountant, they write themselves checks and there's no internal control. So they reconcile the checking account and therefore they steal money. The three internal control objectives can be achieved by applying 5 elements: control environment, risk assessment, control procedures, monitoring, and information and communication. Elements of internal control. So the idea is that you control the control environment, risk assessment, and control procedures and monitoring would stop the threats or significantly reduce them, and that information and communication would be given to management and the business. The control environment is an overall attitude of management and employees and is important. 3 factors include influencing a company's control environment are management's philosophy and operating style. Whether it relates to the management emphasize the importance of internal controls. For example, in the Enron situation, and there's many since Enron, but this is related to Sarbanes-Oxley, the top executives and the accountant who was supposed to be auditing them, Arthur Anderson, they were shredding documents. So they knew what they did was wrong and they had a style and management that did not emphasize the importance of that. The company's organizational structure. So, how is it organized for planning and control? The personnel policies. What type of policies are involved in hiring, training, evaluating, compensating, and so there's a lot of conflict of interest or personal ethic codes. But one of the things that happens is if your compensation is strictly tied to the increase in the stock price, you might be more incentivized to make short-term sacrifices like earnings management and do things that are not technically legal, right? If you got compensated immediately for that, right? So you have the CEO, then you have the employees, then you have policies and the management style. All businesses face risks such as changing customer requirements, competitive threats, regulatory change, and economic factors. Management should identify those risks, analyze their significance, assess their likelihood of occurring, and take necessary actions to minimize them. Control procedures are reasonable assurances that the business's goals will be achieved, including preventing fraud. So, some control procedures are competent personnel, right? Hiring people that have the skill set, rotating duties, mandatory vacations. One of the key things is like when someone will never take a vacation and they won't let the other person see what they do in their job, that can be a telltale sign that they are cheating or stealing. Separating responsibilities for related operations, separating operations, custody of assets, and accounting, proof and security measures. Successful companies need competent employees who are able to perform their duties. Procedures should be established for properly training and supervising. It's also advisable to rotate duties of accounting personnel and mandate vacations. Cases of employee fraud are often discovered when a long-term employee who never took a vacation misses work for some reason, and then someone else looks at the books. The responsibility for related operations should be divided among two or more people. If the same person orders supplies, verifies it, pays the supplier, then that's the opportunity for abuse. Quantity and quality of suppliers received may not be verified. Thus, the company may pay for supplies that weren't received or that were of poor quality if they don't have checks and balances, or supplies may be stolen. For those reasons, the responsibilities for purchasing, receiving, and paying for supplies should be divided among three people or departments. Many times in smaller companies, it's harder to separate the duties because you don't have that many employees. The responsibility for operations, custody of assets, and accounting should be separated. The accounting records serve as an independent check on the operating managers and employees who have custody of the assets. To illustrate, employees who handle cash receipts should not record the cash receipts in accounting. To do so would allow the employee to borrow, steal, or hide. Proofs and security measures are used to safeguard. Proofs involve procedures such as authorization, approval, and reconciliation. Documents used for authorization and approval should be pre-numbered, accounted for, and safeguarded. Pre-numbering documents, like a voucher, helps prevent transactions from being recorded more than once or not at all. Monitoring the internal control system is used to locate weaknesses and improve controls. Monitoring often occurs in observing employee behavior and the accounting system for indicators of internal problems. So, warning signs of a problem. Warning signs for people: abrupt change in lifestyle without winning the lottery, close social relationships with suppliers, refusing to take a vacation, frequently borrowing from other employees, excessive drugs or alcohol, or gambling. Warnings of the system: missing documents or gaps in transaction numbers, an unusual increase in customer refunds, differences between daily cash receipts and the bank deposits. They could be pocketing the money. Sudden increase in slow payments. Employee may be pocketing the payments. Backlog of recording transaction, possibly an attempt to delay fraud detection. So information about control environment risk, procedures, monitoring is used by management to guide operations and ensure compliance with reporting, legal, and regulatory requirements. Management also uses internal information in assessing the events. Let's skip the checkup corner. So internal control systems can only provide reasonable assurance. They cannot In other words, they cannot guarantee that there is no human element of the control or that the cost benefit is not considered. So one of the reasons you don't see security guards all the time at a bank is because the amount of cash that the person probably has access to if they're going to rob the bank is less than the cost of maintaining the um, security guards. So the cost benefit of paying for that compared to losing the amount of cash or the insurance covers it. So a lot of times they won't put security guards at banks. A lot of banking is all electronic anyway. They're not storing all that cash on site. Cash includes coins, currency, which is money, paper money, checks, and money orders. Money on deposit with a bank or other financial institution that is available for withdrawal is also considered cash. Cash is the asset most likely to be stolen or used improperly. To protect cash from theft or misuse, a business must control cash from the time it receives it until the time it deposits in the bank. I was just working with a client who is a property management company, and they took over for several condo associations that this other property management company was stealing from. They were moving money in and out of the bank account. They had access to it, and in a condo association, it's really like a board that's elected of people that live there, so they didn't notice the money was missing. Businesses normally receive cash from customers purchasing products or customers making payment on account. An important control aspect is to protect cash received in over-the-counter transactions or cash register. So if you're bringing the money into the cash register, then the receipts go to the accounting department, they make a journal entry, and then if somebody puts the money in the bank account, or the cash goes in the cashier's drawer, which goes to the cash department and then goes to the bank account. Salespersons may make errors in making change for a customer or ringing up sales. As a result, the amount of cash on hand may differ. Such difference is called cash short and over. For example, the cash register total sales for May 3rd is $35,690. However, the receipts from cash sales are $35,668. The cash receipts and shortage would be recorded. So basically, they took in cash, they have a cash shortage, a short or over, and then it's 35,690 is the actual sales. If there's a cash shortage, the short and overage is debited. So that was a cash shortage. If there's a cash overage, it's credited. At the end of the accounting period, a debit balancing the cash shortage is included in miscellaneous expense on the income statement. Alternatively, if there's a credit balance at the end, it would be included in the income part of the income statement. Cash received through the mail when customers pay their bill is usually in the form of check or money order. Most companies design their invoices so customers return a portion of the invoice, called a remittance advice, with their payment. This helps to make sure that the cash received in the mail is put to the right account. There's also such a thing called electronic funds transfer, or EFT. Many customers authorize automatic bank transfers to pay monthly bills such as cell phone, internet, electric. In such cases, the company sends the customer's bank a signed form from authorizing monthly transfers. Each month, the company notifies the customer's bank of the amount to be transferred that should take place, and on the due date, the company records the electronic transfer as a receipt of cash in its bank and posts it to the customer's account. Companies encourage the use of EFT for the following reasons. It's much more cost-effective than receiving cash payments through the mail. It enhances internal controls since the cash received is directly deposited without any employees handling bank, and it speeds up and reduces late payments from customers and the processing time of cash. The control of cash should be provided reasonable assurance that payments are made only for authorized transactions, that cash is used effectively and efficiently. For example, control should ensure that there are available discounts are taken. A voucher system is set up for authorizing and recording liabilities and cash payments. Voucher is a document that serves as proof. So at Elms, if I want to order anything, I must first apply for a voucher and say what I'm ordering, make sure it's in the budget, get approval. Then when it comes in, I have to verify, or someone else has to verify, that what I put on that voucher was actually received. In a manual system, a voucher is prepared after all supporting documents have been received. For the purchase of goods, a voucher is supported by a supplier's invoice, purchase order, or a receiving report. After the voucher is prepared, it's submitted for approval. When it's approved, it is filed by the due date. Upon the payment, the voucher is recorded in the same manner as accounts payable. In a computerized system, data such as purchase orders, receiving reports, at the end of the due date, the checks are automatically generated to creditors. At that time, the voucher is electronically transferred to the voucher file. Cash can also be paid by EFT. For example, a withdrawal from a bank account using an ATM machine, payment of wages from a payroll check, or a payment to a supplier or vendor. A main reason that a company uses a bank account is an internal control. Some of the control advantages of bank accounts are they reduce the cash on hand, provide independent recording of cash transactions, reconcile the balance at the end of the month, and use the bank to facilitate EFT systems. Maintain all records of checking account transactions, and you get a bank statement monthly, mailed or usually online. And it shows beginning balance, any additions to the bank account, any deductions, and the ending. Companies should be reconciling their bank statements monthly. This is an example of a bank statement. So as you can see, this is the name of the bank, the location, the account number, the date, the balance, how many deposits, how many withdrawals, how many other debits and credits, and what's the ending balance. And then it will list check numbers and the amounts. Non-sufficient funds we'll talk about. There's also errors, miscellaneous. ACH is automatic clearinghouse, which means electronic payment. And service charges are what the banks charge you to manage the checking account. A company's checking balance in the bank records is the company's checking account balance in the bank records is a liability. Thus, the bank records the company account as a credit. Because the bank statement is prepared from the bank's view, a credit memo indicates an increase. Likewise, a debit memo indicates a decrease. A bank makes entries. So the bank accounts for the cash opposite of the business. Deposits made by EFTs, collections on notes receivable, proceeds from a loan, interest earned, and a correction if there are any bank errors. Bank makes debits for the following: payments made by EFTs, service charge, customers' checks returned for non-sufficient funds, and any correction. So the company has a balance, and remember, cash should have a debit balance, right? So debits increase, credits decrease, a cash. The bank has the opposite situation because they're holding your money, and that's a liability. The following things are memos on a bank statement. Error correction is EC. Non-sufficient funds means someone wrote you a check and then they didn't have enough money in their bank account. Or vice versa, you didn't have enough money in your bank account if you've overdrawn your account. Service charge, there's a fee for that. ACH is automatic clearinghouse. MS is miscellaneous items, such as a collection of a notes receivable. So if you have a loan with the bank, they could automatically collect. A lot of times you sign up for that, it saves you some interest. The cash balance shown by the bank statement is usually different from the company's balances. Why are there differences? Could be a delay by either the company or the bank in recording a transaction, so it hasn't cleared, quote unquote, or the bank has debited or credited the company's account for the transaction. The company will not know that until they receive the bank statement, or there's an error, either made by the company or the bank. So what we're going to do is we're going to work on it. So we have a bank statement that shows deposits, miscellaneous, checks, non-sufficient funds, and a charge. This is the actual company records. So they have different amounts to ending balances. That's why we would use a bank reconciliation. It's an analysis of items and amounts created the difference between the cash balance reporting in the bank statement and the cash account ledger. The adjusted cash balance determined in the bank reconciliation is reported on the balance sheet. The bank rec usually divides into two sections. The bank section begins with the cash balance according to the bank statement and ends with adjusted balance. The company begins with the company's balance and ends with adjusted balance. The adjusted balance from the bank and the company must be equal. We'll do this in Excel in another video. So here it is. It's cash balance, deposits not recorded by the bank, which is called a deposit in transit, or outstanding checks not paid by the bank. So you wrote someone a check, you see it in the company records, but it hasn't been cashed yet. Then if you go down here, it's the company's balance, cash, credit memos, notes collected by the bank that the company hasn't recorded, debit memos, so non-sufficient funds, so someone bounced a check to the company, and service charges, and they get to adjusted balance. So how to prepare a bank reconciliation, we're going to do that in Excel, but you add deposits not recorded, you deduct outstanding checks, and you determine the adjusting balance. On the company section, you start with it, you add credit memos, which is a notes receivable or something you haven't recorded, deduct memos, debit memos, and then any non-sufficient funds, and you get to an adjusted balance. So the following items were identified when they did it. So they have a check not recorded on the bank statement. So they have these outstanding checks. They have a notes receivable plus interest collected by the bank not recorded in the credit memo. And then customer Thomas Ivy has a $300 return check by the bank for non-sufficient funds, and the bank's service charge is $18. In addition, check number 879 for $732.26 was recorded on the company's journal, so you made a transposition error. So here's what will happen. It'll be easier to walk through in Excel, but you start with the company's at the bank balance, you add the deposit in transit, you subtract all the checks that were in the company's records that the bank didn't have, and you get an adjusted balance of $2,630.99. On the company's record, you start with their cash balance, the note collected by the bank, you add the note collected by the bank. So someone owed you money and the bank collected for you. Then you subtract the return check for insufficient funds. You subtract the $18 in service charges, and then you subtract the error you made where you recorded a check wrong. And that should get you to the adjusted balance of 2630.99. If these match, then you've done the bank reconciliation correctly. So in order to fix this, then we would need to make journal entries, right? So we only make journal entries for things that happen down here to the bank to the records for the company, not the bank records. These things are timing differences. So we would collect the cash 408, and then we would relieve the notes receivable and recognize interest revenue. We would put back on accounts receivable to Thomas Ivy because his check bounced. We would have a miscellaneous expense for the bank charge, and we would add $9 to accounts payable because we wrote the check for a wrong amount, and we credit cash. The objective of bank reconciliation is internal controls with the bank record and bank statement. In doing so, errors or misuse of cash may be detected. It also enhances the internal controls of a bank rec should be prepared by an employee who does not take part in the cash transaction. Otherwise, mistakes may occur, or it's more likely that cash will be stolen or misapplied. We're going to skip that. We'll do it. So to talk about petty cash, in particular, it's not practical for a business to write checks for small amounts or such as postage, minor supplies. So usually they have a petty cash fund. It's a special fund where a certain amount of money is left in a drawer, and like the admin goes and gets things that you would just pay cash for. Petty cash is established by estimating the amount of payments needed from the fund during the period, such as a week or a month, and then they write a check, and it's cash for that amount. The money obtained from cashing that check is given to an employee called the petty cash custodian who disperses the money. The petty cash fund is normally replenished at periodic intervals when it's depleted or when it reaches a minimum amount. When the petty cash fund is replenished, the accounts are debited and determined by summarizing the petty cash. So here's an example. Let's assume we want to establish a petty cash fund of $500. On August 1st, we enter a record. So we debit petty cash, credit cash. So we take it out of the bank account, we put it in an account called petty cash. The only time petty cash is debited is when you establish the initial fund. Then at the end of August, there's $30 of petty cash on hand and the petty cash receipts for the following items. So we spent the money. We have office supplies, we have postage, store supplies, and miscellaneous. So we spent $467. If there's an amount in the petty cash that does not equal, the difference is recorded to cash short and over. And the preceding entry, the example, 470, is needed to replenish the cash amount. So we go and we make a journal entry to the accounts. So 402 for office, 35 for supplies, 30 for administrative. Cash short and over was $3 we didn't account for, and we credit cash. Companies often use cash for special funds purposes. On the financial statements, cash is the first asset, current assets, right? Cash and cash equivalents. The other things that are equivalent to cash are US Treasury bills, notes issued by major corporations called commercial papers, and money market funds. So you would say cash and cash equivalents reported on the financial statement. We're not going to talk about compensating balances. and we'll do this at another point. So that's the overview. I'll make a separate video of how to do this in Excel.